Gap trading focuses on price gaps between a stock's closing price one day and its opening price the next. These gaps signal significant market shifts and present unique trading opportunities. Gaps can occur due to earnings announcements, economic reports, or major news events. Understanding gap trading can be a valuable addition to your trading arsenal. Gaps represent potential turning points in a stock's price movement. Positive earnings, surprises, or news of a takeover can drive these shifts. Gaps offer quick profit potential. A gap up triggers buying pressure, while a gap down benefits short sellers. However, not all gaps result in profitable trades, and some can reverse quickly. Understanding the different types of gaps and their characteristics is crucial. This knowledge helps differentiate genuine trading opportunities from those best avoided. There are 4 primary types of gaps: common, breakaway, runaway, and exhaustion gaps. Common gaps are small and usually filled quickly. Breakaway gaps signify a potential shift in the stock's price trend and are often accompanied by increased volume. Runaway gaps occur within a strong trend and signal its continuation. Exhaustion gaps mark the end of a trend and often indicate a potential reversal. Each type has unique characteristics and implications for traders. Understanding these differences is crucial for successful gap trading. Common gaps are small and tend to be filled quickly. They often occur without major news and are less significant for trading. While they may not present significant opportunities, they can confirm or refute other trading signals. Exercise caution and look for confirmation from other technical indicators before trading common gaps. Breakaway gaps signal a potential shift in the stock's price trend. These gaps are significant because they indicate a strong move in the market, often driven by news or earnings reports. When a breakaway gap occurs, it can be a sign that the stock is entering a new phase, either bullish or bearish. These gaps occur when the price breaks out of a consolidation pattern, indicating a surge in buying or selling pressure. This breakout can be a powerful signal for traders, as it suggests that the stock has overcome previous resistance levels and is poised for a significant move. Traders often look for these patterns to identify potential entry points. Breakaway gaps often act as support or resistance levels and are accompanied by increased volume. The volume spike confirms the strength of the move, providing additional confidence to traders. When a stock gaps up or down with high volume, it indicates strong conviction among market participants. Trading breakaway gaps can be highly profitable, but wait for confirmation before entering a trade. Confirmation might come in the form of a retest of the breakout level or a continuation of the trend. Patience is key, as jumping in too early can lead to losses if the gap fails to hold. Look for a retest of the breakout level or bullish-bearish candlestick patterns near the gap area. These patterns can provide additional confirmation that the breakout is genuine and not a false signal. Technical indicators such as moving averages or RSI can also help in validating the strength of the move. These patterns further strengthen the breakout signal. Recognizing these signals can help traders make more informed decisions and increase their chances of success. It's important to combine multiple indicators to get a clearer picture of the market dynamics. Proper timing and risk management are crucial for success. Setting stop-loss orders can help protect against significant losses, while a well-thought-out trading plan can guide your decisions. Always be prepared to adjust your strategy based on market conditions and new information. Runaway gaps occur within a strong trend and signal its continuation. These gaps are significant because they indicate a strong market sentiment and a high level of confidence among traders. When a runaway gap appears, it often means that the current trend is likely to continue for a considerable period, providing opportunities for traders to capitalize on the momentum. These gaps are larger and accompanied by high trading volume, indicating strong conviction among traders. High trading volume during a runaway gap suggests that many market participants are in agreement about the direction of the trend, adding further credibility to the signal. This surge in volume can be a key indicator that the trend will persist, making it an attractive point for entry. Identifying runaway gaps is straightforward. They appear as large gaps in a steep trend. These gaps are usually easy to spot on a chart because they stand out due to their size and the sharp movement in price. Traders should look for these gaps in the context of an existing trend. as they are less likely to occur in a sideways or choppy market. Trading runaway gaps can be profitable but requires careful timing and risk management. Entering a trade too early or too late can result in missed opportunities or increased risk. Therefore, it is crucial to have a well-defined strategy and to stick to it. Proper risk management techniques, such as setting stop-loss orders, can help mitigate potential losses. One strategy is to wait for a pullback towards the gap before entering a trade. This approach allows traders to enter at a more favorable price, reducing the risk of entering at the peak of the gap. A pullback towards the gap can provide a better risk-to-reward ratio and increase the likelihood of a successful trade. Another approach is to use trailing stop-loss orders to protect profits. Trailing stop-loss orders automatically adjust as the price moves in your favor, locking in profits while allowing the trade to continue benefiting from the trend. This method can be particularly effective in a strong trending market where the price is expected to continue moving in the same direction. Set trailing stop-loss orders below recent swing lows for long positions. This ensures that if the price reverses, you will exit the trade with a profit or minimal loss. By placing the stop-loss below recent swing lows, you give the trade enough room to fluctuate while still protecting your gains, or above recent swing highs for short positions. Similarly, for short positions, placing the stop-loss above recent swing highs helps protect profits while allowing the trade to continue benefiting from the downward trend. This strategy helps manage risk and ensures that you lock in profits as the market moves in your favor. This locks in profits as the stock moves in your favor. By using these strategies, traders can effectively capitalize on runaway gaps and maximize their potential returns. Properly identifying and trading these gaps can lead to significant profits, but it requires discipline, patience, and a solid understanding of market dynamics. Exhaustion gaps mark the end of a trend, often signaling a significant shift in market sentiment. These gaps frequently indicate a potential reversal, suggesting that the prevailing trend is losing steam. They typically occur after a sustained move, whether it's an upward surge or a downward plunge. However, these gaps fail to continue in the same direction, leading to a period of sideways movement or even a reversal. Exhaustion gaps are characterized by low trading volume, which suggests that the momentum driving the trend is fading. Identifying exhaustion gaps can be tricky, as they often blend in with other types of gaps. However, low volume is a telltale sign that can help traders distinguish them from other gaps. Unlike runaway gaps, which continue in the direction of the trend, exhaustion gaps are often filled quickly as the market corrects itself. Trading exhaustion gaps can be risky due to the inherent volatility and uncertainty in the market. However, they offer opportunities for experienced traders who can navigate the complexities and make informed decisions. It's crucial to wait for confirmation of the reversal before entering a trade to avoid potential pitfalls. Look for bearish candlestick patterns, which can provide additional confirmation of a trend reversal. Alternatively, use oscillators to identify overbought or oversold conditions, which can signal that a reversal is imminent. Proper risk management is essential when trading exhaustion gaps. Setting stop-loss orders and managing your position size can help mitigate potential losses. Reviewing past trades and learning from both successes and mistakes can improve your ability to spot and trade exhaustion gaps effectively. Continuous education and staying updated with market trends and trading strategies are key to mastering the art of trading exhaustion gaps. With practice and diligence, spotting and trading exhaustion gaps can become a valuable skill in your trading arsenal. Mastering gap trading requires a disciplined approach and understanding market dynamics. Different types of gaps require different trading approaches. Common gaps are best avoided due to their unreliability. Breakaway gaps present excellent trading opportunities. Runaway gaps can be highly profitable but require careful timing and risk management. Exhaustion gaps offer opportunities for experienced traders. Risk management is crucial in gap trading. Use stop-loss orders to limit potential losses. Avoid overtrading and stick to your trading plan. Trade only when you have a high probability setup. Managing risk is crucial in gap trading. Gaps often occur during periods of heightened market activity, making price swings unpredictable. False breakouts or breakdowns can lead to losses. Implement robust risk management strategies. Use stop-loss orders to limit potential losses. Set stop-loss orders considering the stock's volatility and your risk tolerance. Position sizing is also important. Determine the appropriate amount of capital to allocate to each trade. Risk only a small percentage of your trading capital on any single trade. Effective risk management increases your chances of long-term success. Gap trading can be rewarding for traders who understand its intricacies. Different types of gaps offer different trading opportunities. Combine technical analysis with sound risk management strategies. Use tools like candlestick patterns, volume analysis, and support and resistance levels. No trading strategy guarantees profits. Losses are inevitable. Protect your capital through effective risk management techniques. Manage risk effectively to increase your chances of long-term success. For beginners, start cautiously and build your knowledge gradually. Start with paper trading to practice without financial consequences. Focus on liquid stocks with ample trading volume. Keep strategies simple and avoid complex setups. Implement robust risk management techniques. Use stop-loss orders to limit potential losses. Be patient and disciplined. Wait for high-probability setups. Continuously learn and adapt to market changes. Read books, attend webinars, and seek guidance from experienced traders. By starting small and managing risk effectively, you can navigate gap trading successfully.